Hello, and welcome back to Fintech Recap, the first Fintech Recap of 2025. My name is Alex Johnson. I'm the creator of Fintech Takes, and I am joined, as always, by the man, the myth, the legend, Jason Mikula, publisher of Fintech Business Weekly. Jason, it's great to see your face.
It is fantastic to see your face, and I guess I'm going to see you in person like a couple weeks after this comes out in Salt
Soon.
Lake City. So I've already broken my New Year's resolution to travel less because I've already committed to traveling to like three different cities in January.
Yeah, the trick for folks who are listening to getting Mikula to go someplace is just to like combine things together where he just doesn't have a choice. Because once he's getting on that plane, then it's like, hey man, like I know you're in New York, but hop over to Salt Lake. It's not that far. And if you're crossing the Atlantic all the time and going to other continents, like it's actually not that far. And so very, very easy to get you to go places. I am delighted that I'll get to see you and possibly share the stage with you in Salt Lake. That sounds like a tremendous amount of fun. I feel like we're going to be bumping into each other a lot over the coming year, despite your vow to travel less. But I know you've also been getting a little bit of a holiday time. How's your break been?
The break has been good. So I am visiting family in the Pacific coast of Mexico, which confusingly I always think should be the Pacific time zone. And so as I was looking at my calendar
Yeah,
to
it's
make sure I
not,
wasn't
right?
late to this, it is not. It is the Central time zone. But it's been good. How's your holiday been?
Mine has been good. Speaking of time zones, have not had to change time zones at all, which is amazing. Especially with little kids, like no travel is just. I was kind of thinking about this. Like, if you travel with little kids, it's hard. If you travel during the holidays, it's hard. If you travel during the holidays with little kids, you're going to want to kill yourself. And so I've never done that before. I have vowed that I never will do that, and I'm very thankful and very grateful that my family, my wife's family, even my wife's brother, who normally lives in Japan, flew in for the holiday this year. So we had everybody in Bozeman, Montana. And as I was telling you before we hopped on to record, my only complaint has been that we've had a dearth of snow so far. And so we had a white-ish Christmas, but not quite as snowy as I was hoping. But that seems to be turning. We have snow coming down today. So things are good. Things are good. I'm happy. I also, Jason, got a Christmas present that you might be aware of. For those who are not watching the video, I'm holding up it's called Banking as a Service: Opportunities, Challenges, and Risks of New Banking Business Models by Jason Mikula. I am holding it in my hands. This is so cool.
I feel extremely accomplished. It exists. It's real. People out in the world have copies of it. Yeah. So you'll
Yes.
have to give us a book report at some point.
I honestly am going to do that. I made it a decent chunk of the way through the advanced copy that you shared with me. Although I think I joked with you that the publisher saying like this is not yours, you shouldn't have this, whatever the watermark was, over every single page made it a little distracting to read. So now I like reading physical books. So now I have my physical copy. There's a blurb from Alex Johnson on the back, who's by far the least accomplished of the three people who are blurbed on the back. So thank you for making that happen. But I cannot wait to read the rest of the book and to do an in-depth book report. I mean, I kind of feel like our podcast for the last 2 years has been an in-depth book report on this book before it was written. But nonetheless, congratulations. This is fantastic. I'm going to take this with me to Salt Lake City and get this signed as well. That's my next goal.
I am looking forward to that.
Okay. Well, good man. Speaking of banking as a service and the fact that our podcast has been sort of a recitation of many of the lessons learned that are codified in this book, Jason, I don't know that we're going to go to BaaS Island, but could we at least like kind of like go by it? Can we do like a pass by the island, even if we don't set foot on it?
I think we can, and what Alex is alluding to is a somewhat kind of strange lawsuit slash civil money penalty for CBW Bank, and I'm pretty sure you and I have talked about CBW on the pod previously. But for those who are unfamiliar, in many ways, it's kind of like an OG fintech bank, predating even some of the other early movers in the space. I mean, CBW worked with pioneers like Moven and Simple, as well as being one of the two initial U.S. bank partners for Ripple. The other being Cross River, which of course is remains a major player in fintech and banking as a service. CBW also worked with Bond, which was acquired by FIS and rebranded as Attilio, and Solid, the BaaS platform that was sued by its own investors for allegedly manipulating numbers in its Series B fundraise. The CBW was hit with a consent order in 2020, so actually several years before Blue Ridge got that order in late 2022, which sort of touched off. I think of that as sort of the start of the wave of like BaaS enforcement actions, but this was like several years before that, and largely stemming from BSA AML issues in its lines of business, serving foreign financial banks as well as like money services businesses, and ultimately agreed to exit those lines of business in that 2020 order. But now, or at least it was made public at the end of December, so it would have been in November, the FDIC is seeking what is proportionally a rather large civil money penalty, about $20.5 million, over largely similar AML issues. Uh, while that number pales in comparison to some of the monster fines we've seen, like TD getting, I think it was like 1.3 billion CMP from FinCEN, CBW is a tiny, tiny bank. I mean, I checked the most recent call report, and it's something like 73 million in assets, and about 23 million in total bank equity as of the end of Q3 2024. But despite this rather small asset size, CBW was serving a fairly sizable business processing transactions for foreign financial institutions across a number of lines of business: remote deposit capture, bulk cash repatriation. So things that, frankly, I don't know a ton don't know a ton about, but fairly niche businesses,
Mm.
serving banks and financial companies outside of the United States, including in some higher risk jurisdictions. So specifically mentioned in the CMP, working with a number of banks in Mexico to repatriate physical cash, which is higher risk due to concerns around money laundering and drug trafficking activities, as well as working with institutions in Lebanon and Cyprus. So not exactly like vanilla, grandma down the block lines of business. Um, I think there's a couple of interesting threads here that go beyond sort of the typical BSA AML issues. One is that per the FDIC's CMP order, some of these issues seem to stem from the use of a homegrown AML technology system dubbed Context Engine, which seems to have not been fit for purpose, at least taking the FDIC's allegations at face value, as far as not incorporating all the data that it should have or not analyzing it properly. And perhaps the most important or most interesting piece of this is that CBW itself is actually suing in district court, seeking a preliminary injunction to block the FDIC from undertaking this proceeding in front of an administrative law judge, an ALJ, and instead is arguing that it is entitled to a Article 3 jury. Now, I am not a constitutional law expert, but this basically echoes some of the arguments we saw in Jarkissi, or SEC versus Jarkissi, which were ultimately successful. Um, I did speak with a number of real lawyers who basically the consensus was they thought the arguments CBW presented in its motion were not persuasive. But given the, let's say, uncertain legal and regulatory climate that we're in, sort of a all bets are off kind of mentality of how this could unfold going into a new administration and with judges in courts where they are. So I'm reluctant to like generalize too much from this case, as there's sort of a lot of specifics, idiosyncratic factors and unknowns. But Alex, do you have any uh, sort of key lessons or key attributes you're watching in this one?
Yeah, I mean, it's a really interesting example. There are a lot of sort of idiosyncratic factors that are make it for pretty interesting reading, but are sort of hard to generalize. I mean, the repatriating millions of dollars of cash on like sounds like just pallets that are being lifted by forklifts is pretty wild types of details that you don't see from others. So I think that there are some things that make this one a little bit strange, but I think in general a couple of observations. One is I do definitely think that the homegrown AML system point is one that I would hone in on. I mean, the fact that these guys were very, very early, right? Like even their consent order was 2020. Like that makes them an OG in every respect in this space, right? Like they've been around for a long time. I can see how because they've been around so long, at the time when they started doing this stuff, they would have had to build a lot of stuff internally to handle these processes, right? Because back in the very early days of banking as a service, as I'm sure is outlined in your book, there was not that same ability to just go shopping for systems that were natively designed to handle AML and BSA and transaction monitoring. And it works across multiple programs, but it can roll the details of those individual programs up into more summarized views. Like those types of systems just didn't exist at the time. You couldn't buy them. And so you had to build them. However, I think what this would suggest is that regulators, and I don't think this is unreasonable, probably are going to evaluate those choices against the choices that are now available to banks in the market, where there are a lot more modern systems for doing this, right? And we've talked about a bunch of the companies that have moved into this space, whether it's Cable and Themis or Alloy and Sardine, and just a whole bunch of different companies that do modern AML, fraud, transaction monitoring, specifically tuned to banking as a service and working across lots of different programs that might have different levels of risk. So I think that part of this is a question of sort of technology acquisition. And just, if you're a bank that's in the space, just because the system that you have in place, whether you built it or bought it and then significantly customized it years ago, just because it's been working doesn't necessarily mean that you're going to be sort of immune from the consequences of the system not working perfectly or not being as good as a system that you could get out there. And I mean, Jason, we've seen lots of other examples, maybe more from the CFPB recently, where banks or credit unions have been exposed to regulatory risk due to the systems that they're using or the systems that they choose to buy. So I think this is another example of that a little bit. The other thing that I wanted to bounce back to you is, and this goes to like a kind of a famous phrase in the sort of AML space, which is like the ideal amount of financial crime is not zero, right? Like this choice that banks make to engage in activities. Like if you want to make money, then whoever your chief compliance officer is, they're have this dial on their desk and they're moving the dial up above zero for the amount of financial crime that they know they're taking on, because that's how you have to make money. I guess my question for you is, it seems like in banking as a service and in these more sort of exotic programs and arrangements and all these sort of niche things that CBW and others are doing, it seems like that dial has to be set quite a bit higher than banks that aren't engaged in these activities and that regulators are naturally comfortable with, right? So, like you referenced TD before. Like TD, I think rightly took a huge monetary penalty for being just incredibly lax at a massive scale in what they were doing. But if you sort of visualize like that dial that's sitting on the desk, I would still make the argument in some ways that the dial was probably on the lower end. Now, it was way higher than it should have been and way higher than it is for other large banks. But the problem with TD was lax AML and BSA compliance combined with massive volume and scale and size because they're a massive bank. when you go down to the bottom of the market and you look at these community banks that are, as you said, like um, not that many millions of dollars in assets total as an institution, these tiny little community banks that have been repurposed to do banking as a service, I feel like the scale is smaller in terms of the asset size, the size of the institution. But two things are different. One, the dial seems to be set quite a bit higher than it does in other parts of banking in a way that would, I imagine, freak out regulators. And two, just because the bank's assets are small does not mean that their charter isn't facilitating a large amount of activity overall, right? Particularly as it relates to payments or some of these other sort of bespoke business lines that they're getting into. So I guess this is a long way of saying it seems like there's a incentive in the banking as a service fintech program management space to take on more BSA AML risk. And it also seems like regulators are saying your dial is set way too high here and we need to like reset that to a lower level. What's your take on that?
No, I think that's right. I mean, as I began learning both about sort of AML, CFT compliance and banking as a service, what you're describing as far as using asset size as a rough heuristic for, how closely do we need to be looking at this? How much risk is there? Perhaps was generally true historically, but I think, as ample evidence at this point has shown,
Hmm.
in certain lines of business, asset size may no longer be a good gauge, rough, but good
Mhm.
gauge of how much risk there is. And I think, CBW becomes, another data point that helps demonstrate that. I mean, it's for anyone in the AML space. It's worth reading the CMP because there are some specific details in there that, frankly, make it look like they weren't even trying to tick the
Mm.
box. So, for example, uh, I think they had two BSA officers during the review period. And ultimately, I think four over a span of like 5 or so years, which by itself is already not a good sign.
Yeah, that's
Uh,
bad.
but one of the BSA officers had zero experience in banking, period,
Uh-oh. Uh-oh.
which is not great.
Mm.
And then the way that some of the reporting and authority were structured was such that decisions to file suspicious activity reports, or SARs, were actually carried out by a committee that included the president of the bank and VPs of other functions. And the president of the bank, at least according to the FDIC's filing, explicitly told examiners that, quote, the bank needed to keep its customers' interests in mind when considering whether to file SARs. And so, that I do not know why you I don't know why you would volunteer that information. Um, but it really does sort of paint a picture of, an institution that was not was not doing a great job of balancing its obligation, its legal and regulatory obligations with, serving how it selected and how it served its customers, in a responsible manner. And that carries through to other areas like, independent audit. So, okay, they had an independent audit, but that auditor looked at a total of 10 wires in the year 2018, even though the bank processed 60,000. Um, and so you just have, a handful of these details that you know, give more context to how this happened. I think one sort of last key takeaway I would point out is, again, according to the FDIC's filing, this sort of originated in a report of examination back in 2017, right? So you had a 2017 report of examination. Presumably, you still had problems in 18 and 19 that gave rise to the consent order in 2020. And then you still had problems in reports of examination in 2022 and 2023. So it really feels like, the FDIC appears to have raised ample red flags, ample warnings that appear to have either not been heeded or were not sufficiently remediated in a timely manner. Um, I mean, I will certainly be following this on the side to see, what happens with CBW's challenge, because that, could potentially dramatically reshape how these types of orders are adjudicated if, in the unlikely event, their challenge is successful. Um, but yeah, definitely interesting one to end the year on.
It is, yeah. Well, and I think, I mean, the lawsuit is interesting too because it may sort of presage a era of more contentious relationships between banks and their regulators, right? I mean, like the sort of conventional wisdom around this is that you have to work with your regulator on a regular basis, right? They supervise you as an institution, and so you don't want to sort of ruin that working relationship by suing them or doing other things that will sort of sour the human side of that relationship. So historically, well, I think sort of targets like the CFPB maybe have been a little bit more the focus of the ire of banks and credit unions. Typically, they don't like to sue or sort of have a super contentious relationship with their prudential regulator because, from a supervision perspective, it just makes things weird. I have seen not just this, but other examples recently of maybe banks and credit unions being a little more willing to kind of take the gloves off or to go directly at regulators. So I'll be very curious to see how that part plays itself out. And I think the other thing I'm just sort of watching generally here is there's a lot of discussion around like, is the next 4 years going to be great for acquiring a bank charter, becoming a bank? And like, correct me if I'm wrong, but this is one of many examples of this idea maybe of like charter stripping, right? Where a small community bank is acquired, but then fundamentally its business is taken in a completely different direction. It has nothing to do with the community it was originally serving. They may still nominally serve it, but it's not being served the same way. That has happened a lot in fintech over the last, 5 to 10 years with fintech companies like SoFi and Column and Gico and a number of others acquiring these small community banks. I mean, I feel like that's another challenge with all of this is that the the argument that, hey, we need to be in banking as a service as a small community bank because we have the Durbin exempt interchange, that part makes sense. But if you're just acquiring a bank charter because this is the cheapest bank you could buy, and then you're going to use it for whatever, that might not be something that regulators are quite as comfortable with moving forward.
Well, I mean, that's a whole different can of worms we don't have time for today. What gave rise to, okay, why did SoFi buy Golden Pacific? Why did Column buy, NorCal versus, getting a de novo? That'll have to wait for a different pod.
Yeah,
Um, but I do think that it poses some challenges in, how do you continue operating sort of that legacy business? Like, I believe Column still has a branch. I think it's in like Chico, California or something.
sure. Sure.
Um, how do you, continue running that sort of legacy business while making the investment and building the infrastructure you need to sort of build the business you really wanted to, that was the reason why you acquired this bank? So definitely one worth watching. But Alex, what else are we watching in going into 2025? I think you have our second one for us.
I do, yeah. So another thing we're watching is IPOs. We're on IPO Watch heading into 2025 because supposedly, and who knows, but supposedly 2025 will be the year of fintech IPOs, the year of delayed gratification, I guess we could call it, Jason, because a number of fintech companies have taken steps to go public in this year. There's been reports about Klarna. Obviously, there's lots of speculation around Stripe, Plaid, what have you. The one story that broke in December, and the story was broken by Katie Roof and Paige Smith at Bloomberg, is that Chime is going to be going public in 2025. Again, not a surprise. They've been telegraphing that in various capacities for a while now. Actually, Bloomberg has already broken stories earlier in the year about Chime's plans to go public, but they have actually now engaged with bankers and lawyers to formalize the process of going public. And supposedly 2025 is the year. Now, by way of background, and I know everyone listening knows Chime, so we don't need to do a whole song and dance on everything about the business, but just for context, they last raised, I believe, $750 million in a Series G. At that point, naming things as different series doesn't really make a lot of sense to me, but whatever. $750 million in 2021 at a valuation of $25 billion, which is a lot. Interestingly, there's been a lot of discussion over the last year or so around just Chime's prospects as a public company and how big they are, how successful they've been. You may remember, I think Jason, you and I talked about this on the pod a while back, but Ron Shevlin at Cornerstone published an article in which he claimed, based on his market research, that Chime had 38 million customers in the US, which, to be frank, is an impossibly large number. And I think we said that on the pod at the time. He later revised that number down to 22 million, which still seems really, really high. Chris Britt was interviewed by Jeff Coughlin at Forbes a little after that, in which he said that they had 7 million customers, which feels a little bit more directionally true. Chime, of course, has launched lots of products and has gotten into a lot of new areas like earned wage access, where it launched a product. It also acquired Salt Labs, which was founded by Jason Lee, who was the co-founder of one of the early earned wage access companies. So again, getting into that sort of earned wage access and employer-sponsored fintech area. They've also been starting to do some experiments and a little bit of early work around lending, building on top of their credit builder product, which if you attended the webinar that Jason and I did or have read any of my newsletters, you likely know I have some problems with. So Chime, I guess, Jason, is this very large, very successful, very well-known neobank that makes most of its money from Durbin-exempt debit interchange, makes a little bit of money from other areas like the charge card that it has for its credit builder product. I guess a few other kind of small areas here and there, but it's primarily a debit interchange business. Again, at a massive scale. I don't think 38 million customers massive, but I think 7 million is a very sort of reasonable number that sounds right to me. That might even be Chime sandbagging a little bit in terms of how they define customers there. So they're a very large bank. I think they also have, and when I say bank, obviously bank in quotes because they work with, is it Stride and Bancorp? Am I getting that right, Jason?
Yes, you are.
So they work with a couple of partner banks behind the scenes to enable what they do. And I guess the last point about them is they do, I think I've seen reported, and as my general understanding, have quite a high percentage of customers who have their direct deposits with them because that's kind of core to their whole business model is capturing that direct deposit. So they have a large customer base. They make money on them through debit interchange. They have a relatively high percentage of primary bank account relationships. And I think they have a pretty good brand. Jason, what do you think about the prospects of them going public? I mean, I can't wait to read this S1, but like, what are your thoughts?
Yeah, I mean, it's still hard to sort of stomach, contextualize that
Mm,
25 billion number,
yeah.
which, that was basically at the height of the 2021, like, crazy fundraise, SPAC valuation, meme stock time.
Well,
So,
and
so
Chris
I,
Britt specifically said in an interview at that time, "We're a software company, not a bank." That
I,
was the software company, not a bank era, just for
Uh,
context.
yeah, I do distinctly remember that phrase or that quote. Yeah, we're more like a
Yeah,
technology company. We're more like a software company.
yeah.
I mean, just a couple of points of comparison. So 25 billion. The in my very quick googling, um, the somewhat comparable market cap today, Fifth Third Bank has a market capitalization of about 28 billion. And with about 213 billion ish in assets, it is the 17th largest bank by assets in the United States. I mean, this has been like the perennial. I mean, I remember even actually when I was at Goldman working on Marcus, there was this constant like low-lying angst looking at companies like Lending Club and SoFi, which at the time neither of which were banks, and sort of asking, how does this company have this crazy valuation? And like, we're Goldman Sachs and we're only worth X. And to some extent, perhaps the valuations have become a little more rationalized compared to that frothy time in 2020, 2021. But even looking at something like, Moneyline is just shy of $1 billion market cap. Dave is just over $1 billion. Both of them have seen have sort of seesawed, certainly down from what they SPAC'd at, down I should say down substantially from what they SPAC'd at. Um,
Moneyline acquired too, right? Taken off the market.
yes, yeah, that
Yeah.
was in a very kind of oddly structured deal. Um, so I mean, at this point, Chime from talking with folks who are more plugged in to some of the numbers of the company than I am, it sounds like they have done a good job of targeting a segment of customers or households that are not sort of the lowest tranche, right? So, my perception of sort of Dave and Moneyline, given that historically they entered the market as sort of a lending first product, they tended to attract users who were, to put it bluntly, desperate to borrow money and sort of backed into adding that debit card bank account functionality and never, at least from the stats they've shared publicly, Dave and Moneyline, never have quite achieved the same level of direct deposit adoption and day-to-day use, just sort of given that historic legacy as a lending first product. And the customers they've tended to attract perhaps are lower income and either thin file, low file, or sort of lower credit spectrum. From what I've heard, Chime has done a better job at sort of capturing, uh, call it like the nurse and school teacher segment. So certainly not upper income wealthy, but stable middle class, working class households. To your point, I've also heard that direct deposit adoption, and I believe that was probably mentioned in the Forbes piece as well, um, is quite good, and that customer longevity, uh, you know, is also quite good. So relatively low churn rates compared to what I think you tend to see with like the Daves and the Money Lions. So at this point, I'm also very curious to see the S1 and sort of see how some of the actual financial metrics and then sort of the proposed valuation benchmarks compared to market comps. I'm also curious to see sort of what story Chime tries to tell as they approach the public market. So I think that acquisition of Salt Labs and sort of building, I think it's already been rebranded as like Chime Enterprise, if I'm remembering correctly. Um, so sort of see what is the story that they go out and tell to the market as they approach that IPO, as far as sort of the existing Chime core Chime business, pushing further into lending, which they've been making positive incremental progress in, and then sort of what is the growth story going forward with Chime Enterprise and any sort of other initiatives. But I really feel like until we have that S1, it's all just sort of trying to read tea leaves.
Yeah, I think that's right. I mean, I just to put a fine point on what you said, I totally agree. I think that you have to sort of triangulate between these different examples that we have in the market, right? And so, one category which you outlined is the sort of Dave Money Lion. I think Bridget is another example of this. Like, there's a few of these companies that have sort of staked out this area of we work with lower income customers. So that is consistent with Chime, right? Like, we work on this end of the market. We go after this segment of customers who are less wealthy, who have less money. But the distinction there is that Dave and Moneylion and Bridget and those guys all started with kind of a lending product first. And that was one of the first things. That was kind of the hook product. And as you point out, the combination of starting with lending and starting with lower income customers tends to bring a lot of risk and a lot of desperate customers. It's a negative selection problem that you're sort of having to fight against. And I think that's largely been why those companies have probably not been quite as successful at earning maybe the valuation that they would have wanted, either privately or publicly. Obviously, a couple of them have been acquired already. Dave continues on the public markets. I think it's also probably why those companies have gotten themselves into some regulatory issues, because it's just, if you have that negative selection problem you're dealing with, you sort of have to somewhat engage in a hand-to-hand combat with your customers, and that can sometimes get a little ugly and sometimes cross some lines. Dave's taking tips and manipulating people by showing them empty plates of food when you're not giving them a tip, like dark patterns and sort of nasty stuff that I'm not a big fan of. I think that kind of goes hand in hand with that model. Then on the other end of the spectrum, you have the sort of what I would call lending first neobanks, but that started with a very different customer segment, right? And so this is the SoFi, Lending Club, those kinds of companies. Yeah, I think even Affirm would sort of generally fall into this category in some ways, although they're less of a bank than the other two, where they're starting with a higher income customer and they're starting with lending first. But because they're starting with that high end customer, because their product, like in the case of SoFi, was student loan refinance for graduate students at Stanford, you're just fishing in a very different pond. And so you're starting with lending first, you're getting that lending experience, but you don't have that same negative selection problem that Dave or Moneyline or some of those other companies have. And I think in a lot of cases, that's kind of the ideal place to start, because you get to learn lending and get good at doing lending and learn how to make money at lending, which is the main way you make money as a bank. And then you sort of back your way into a full banking relationship. Obviously, Lending Club and SoFi both acquired banks, so they have the full benefits of a bank charter. So then you look at Chime, and Chime is entering the public markets. And I agree with you. Like, they've avoided, I think, that Moneyline Dave problem of combining low income customers with that sort of desperation and negative selection that starts with lending. And they've been very careful around lending, which I think is smart. But at the same time, they do have to make money as a bank in some capacity, potentially. And lending is a good way to do that. And they have almost no real experience doing lending to their core customer base. They just got into earned wage access, which is now, according to the CFPB, a loan. They are starting to kind of dip their toes in that area, but they don't have a ton of experience doing that. And if you know anything about my objections to credit builder products, I don't think their credit builder customers are necessarily going to be a good pool to lend into necessarily. And so they have this sort of lending question mark. And then, of course, they're going public without the benefits of having a bank charter, right, or being a bank. And so I think you teed it up really well in saying that, like, they're going to exist somewhere in this nebulous space between the Money Lions and Daves of the world, but also not quite on the side of the SoFi Lending Club Affirm side of the market. They're going to exist somewhere in the middle. And I think, the point about Chime Enterprise and acquiring Salt Labs is a really good last one to end on, which is just maybe they have some path out of this, or path towards growth or greater profitability, that's completely different than what anyone else is doing in the market, right? And the example I've been thinking about is, if you look at the largest employers in the country, like Walmart and Amazon, they invest quite a bit of their own money in building employee solutions, benefits, including fintech offerings, right? Like everything Walmart is doing with One, a lot of it relates to serving Walmart's employees, and they're the largest private employer in the country, right? And so I think that Walmart and Amazon, they're going to build all of that infrastructure to work with low income employees and make their lives as sort of stable and healthy as possible, so that they stay stable, healthy employees of Walmart or Amazon for as long as possible. They're going to build all that infrastructure themselves. Chime, I suppose, through its acquisition of Salt Labs and sort of going in this direction, they could make the argument, and maybe they will in the S1, that they can be the infrastructure for every other large employer who's not Amazon or Walmart to provide that sort of financial services, financial health, financial stability infrastructure. And like, there's a world in which, and this is kind of a depressing world to think about, but like in which your employer is a co-sponsor of your mortgage, because without them they would have no ability to buy a house in the community that they need you to live in so that you can work at that company, right? Like there's sort of a slightly dystopian version of the future where you see large employers playing a greater role in the financial services lives of their customers. And through the acquisition of Salt Labs and getting into earned wage access, I could see Chime playing into that space. So I think that is, if you know Pinnacle, that would be sort of the shooting the moon version of what Chime could potentially do. But to your point, we'll have to wait for the S1 to see.
I do not know Pinnacle, but that is also a phrase in Hearts, which is the card game I grew up playing.
Yes, there you go.
But actually, I mean, similar topic and segueing into our next story, which is about
Take us there.
Walmart and Branch.
Yeah.
Which I'll admit, Branch is a fintech that I'm not super familiar with. And so really had a chance to learn a little bit more about it in the course of this story. So the CFPB has had a very busy end of the year holiday season.
They have.
I can't imagine why. Um, but one of the cases that caught my attention was the action against Walmart and Branch. So specifically, Walmart initially through a third-party vendor that ultimately Walmart acquired, partnered with Branch, which does instant payout and digital wallets, to offer Walmart's Spark drivers these Branch accounts. The Spark drivers are essentially comparable to Uber in the sense that they're 1099 contractors. They're not employees of Walmart or this third party that had been sort of coordinating or managing those drivers on Walmart's behalf.
Are they delivery drivers? That's what they do?
Yeah, it's
Okay.
last mile delivery.
Got it.
So equivalent to like those Amazon vans that drive around.
Yeah. Okay.
So the CFPB, and I will put sort of the caveat here that this is based on the CFPB's filings, which I'm sure Walmart and Branch probably will dispute. But CFPB alleges that Walmart and Branch illegally opened accounts on drivers' behalves without their permission, which also would mean without the chance to, review terms and conditions, fees, etc. And that in some cases, drivers' pay was deposited into these accounts without drivers' knowledge or permission, which essentially forced them to sign up or required them to accept terms and conditions in order to access their pay. Previously, drivers were able to have their pay dispersed sort of regularly via direct deposit, but Walmart ultimately required drivers to use Branch accounts or essentially be terminated. According to the CFPB, drivers were required to pay junk fees. I'm making air quotes around that. To instantly cash out their earnings. So that would be instant transfer fee comparable to what you see on like Venmo or Cash App or some of the cash advance services. And again, according to the CFPB, Walmart and Branch promised drivers, quote unquote, instant access to their pay. But in reality, drivers experienced delays or incurred fees to transfer their money elsewhere. I, being me, found it deeply amusing that Branch's bank partner is none other than Evolve Bank and Trust, which, interestingly, the CFPB acknowledged in its statement that Evolve has had partnered with my other favorite company, Solo Funds, which CFPB is suing. But it is worth noting that Evolve itself is not a defendant in this particular case, the Walmart Branch case. So, I think there's a number of interesting questions here, but taking the CFPB's allegations at face value, Alex talking a lot about the idea of sort of employee benefits and the ability of employers, to offer these kinds of benefits either as a way to attract employees or to retain them, or even, I mean, to some of what you were getting at in a prior story, are there ways that you can, essentially make your employees' lives uh, less stressful, ultimately, so they're better employees. And I think particularly in the case of lower income households or lower income segments, day to day, week to week cash flow is a real stress and can interfere with the ability to even physically get to work. If you have a situation at home, your car breaks down, what have you. So I think there is an opportunity to provide a benefit that is ideally win-win. But this case suggests the reality is perhaps a bit more complicated, particularly when these features may cause users, employees to either incur incremental costs or in this case, actually not have a lot of choice in the products that they're using. So, I mean, based on how the CFPB has portrayed this, um, does it give you any pause about the idea of employers, particularly extremely large ones like the
Mm.
Amazons and the Walmarts, of offering these kinds of benefits if they're sort of optional, not optional?
Yeah, no, I think it definitely does. I would say that I think in general, and again, we're taking the CFPB sort of at their word as we do the analysis here. So we'll wait to see if Walmart or Branch push back at all and where they push back. But in general, I'm happy actually that the CFPB is looking at this, right? Because I do think that employers sponsored financial services solutions are one of those areas that can kind of sit under the surface and that don't get as much attention. But you have to figure, especially for lower income employees, you're kind of at the mercy of what your employer either tells you to do, suggests that you do, or apparently in this case requires you to do. And so I think this is an area that deserves a lot of scrutiny, because if you are inserting yourself into the choices that your employees are making about how to manage their finances, particularly if there's some benefit in it for you, and presumably you wouldn't be inserting yourself if there wasn't some either hard monetary benefit or softer sort of benefit around retention, loyalty, engagement, whatever metrics you care about, um, you should be subject to scrutiny around this. And so I think in general, first point would be I'm happy, and I don't always say this about the CFPB under Rohit Chopra and their sort of expansion of the regulatory perimeter. This is an area where I'm happy to see the regulatory perimeter expand a little bit, because I do think looking at employer based financial services solutions is really important. I guess the part I don't really get here, Jason, and maybe there was something in the documentation provided the CFPB that can give us a clue here, but I don't really understand why Walmart would do this, if indeed this is what happened, because you know I can totally understand offering this as a benefit. You and I have talked before about earned wage access. I actually don't think it's unreasonable, if everything is properly disclosed, to charge for the instant delivery of funds, right? Like if you're bypassing the ACH settlement window and you're instantly crediting someone for funds, I don't think that's a totally unreasonable thing to ask someone to pay a $2-3 fee for. So I don't think it's unreasonable. The part that strikes me as strange and that I don't understand is, why would they make this something that's required? Or in certain cases, why would they open up accounts with someone without their knowledge or permission? Like, why did this become a priority that they were sort of overriding the choice of the end employees rather than just giving them the option, right? Like, hey, we can do direct deposit, we can transfer money the same as we always do. It has its own sort of limitations that you might not enjoy, or you can use this other thing. Totally up to you, use it or not. The going beyond that point is the part that I find troubling. And I guess the breadcrumb that I would lay out there, and again, this is just speculation on my part, I don't know exactly how this stuff works, is it seems like, particularly in a very large company like a Walmart or an Amazon, um, there is this thing that happens where this becomes an area that's managed by a lot of individual people who have sort of individual incentives in place, right? And so, if you're Walmart globally, probably Walmart at a sort of global C-suite level probably wouldn't have signed off on like we're going to require the employees to do this. Like that doesn't. Why are we doing that? That doesn't really make a lot of sense. But somewhere within the bowels of the organization, I'm guessing there was a different set of incentives between Walmart and Branch. And Branch, of course, would have very different incentives here to push this or to make this the default or to require people to do this. And so the thing this is making me think about, Jason, is and I asked this question in my newsletter a little while ago. Walmart with One, which is its fintech arm that it's doing, it sort of kept One at an arm's length distance, where it's a separate organization. They are apparently going to be investing more money into One, along with Ribbit Capital, which is their sort of external venture partner in the project. And that has never made a lot of sense to me. I don't really understand why Walmart treats it as a totally separate organization. But I wonder if this type of thing is sort of a hint as to why that might be a benefit, right? Because if One is one single organization that's consolidating all of these functions into one place, that gives you a little bit more ability to sort of as Walmart control the organization and to control what happens and the choices that are made. Whereas what Walmart has historically done has been much more of a decentralized approach to this, where financial services becomes embedded in all these different parts of Walmart. And I wonder if that decentralized approach leads to problems like this. What are your thoughts on that?
Yeah, I mean, I share some of your confusion at sort of like the fact pattern here.
Yeah.
It, it why why require the use of the product, or why disallow a regular ACH transaction doesn't intuitively make a lot of sense absent some kind of to your point incentive presumably between Walmart and Branch, or
Yeah.
Walmart, this third party administrator that existed that Walmart
Right.
acquired,
Right.
and Branch. um, the story with One and it being a separate company that Walmart is an investor in, my very like armchair analysis of that is, Walmart has long tried and not been particularly successful at making financial services a significant driver of its business. I'm not a retail expert or deep Walmart watcher, but the way that I've always thought about it was primarily as an enabler, right? So you have the Walmart card, which was basically just a licensing and branding deal with Green Dot, or you have certain remittance stuff in store, which I forget if it was Ria or MoneyGram or some combination of them, but like primarily things that would either drive foot traffic into the store, and or enable people to transact in Walmart, but not necessarily an actual driver of Walmart's like revenue or P&L. Like there didn't seem to be sort of like a strong direct economic deliverable for those products or for those business lines. I think by taking that and putting it outside of Walmart, it has that standalone accountability of like we are expecting this to be a standalone, profitable, significant business, and by sort of
Yeah.
putting it outside the mothership may give them both more space, but also perhaps more importantly, more accountability for achieving that.
Yeah.
Um,
Well, and
but yeah,
achieving it
this
in a compliant manner that doesn't run afoul of some of these problems. Yeah, I mean,
yes,
I think
definitely.
that's right, and it is interesting because, as I understand it, one of the things One is already engaged in is earned wage access for employees, right? And so, like, this is an area where there already is competition, I guess, between legacy Walmart operations and partners and this new One organization that's coming in, and so I do think that you're right. They're in the process of this like rationalization process, trying to get to something that makes a little bit more sense.
Well, and I mean, to your point about just like the sheer scale of an organization like Walmart and how
Yeah.
many different people in different business units have different different projects, maybe different pet projects they don't want to see killed or
Yep.
consolidated because it's their
Yep.
power center or their reporting line. I mean,
Hmm.
we already saw Walmart's willingness to kill off its co-brand credit card deal with Cap One, with the
Yeah.
with the sort of accepted conventional wisdom being that was to shift that issuing eventually to One. And
Hmm.
so here you have another example where it's like, oh, well, it certainly feels like a lot of what Branch does could be overlapping or duplicative with One, particularly as that one business unit acquired Even, which was an EWA provider. Too many
That's
companies
right.
named Even, but yeah, there was one that was Even Financial Services or something, which was a
Yeah, yeah,
EWA
yeah.
provider, not the
That
one
was one of
Moneyline
the
acquired, which was an affiliate marketplace.
well, the problem is these
Yeah,
things are so close to each other that like they share the same name and they're not that dissimilar from a
yeah,
business perspective. No, yeah, you're exactly right. So I think that this consolidation and rationalization process seemingly will continue at Walmart. And I would guess that regulatory trouble for the more legacy ways that these problems were solved at Walmart will just accelerate that process of rationalization, would be my educated guess. And I guess we'll have to see with the new CFPB if this continued focus on employer based financial services solutions continues. I hope it does, because I do think with Chime, with Walmart, with Amazon, with a number of other examples, this is going to be an area where we're going to see more and more overlap. Sometimes these ideas in fintech, they happen and then they don't produce any results right away and we all kind of move on. But I do think employer sponsored fintech has some legs and will be a story that we continue to touch on in the new year. Jason, speaking of the new year, we should start off the new year with a couple of rants. So for our Can't Let It Go segment, would you like to go first or would you like me to go first?
I can go first. It's a short one. I'm sure that I imagine our listeners are aware of the Luigi Mangione case. My rant is not
Yeah.
directly about that. The young gentleman accused of killing the United Healthcare CEO. My
Hmm.
rant is about the brief uh, ability to bet on his fate on the prediction market. I think it's pronounced Kalshi,
Yeah.
which I think after a couple of days and significant public outcry, the ability to bet, and frankly, I didn't even read what the bet was. I assume it was like the outcome of an eventual trial or guilty plea or
Sure.
whatnot. Uh, More taking away like the extreme late stage capitalism narrative of this story. I mean, already dystopian enough.
Yeah.
The alleged assassination of healthcare CEO and sort of everything that says about the state of healthcare and
Yeah.
access to healthcare and sort of uh, how it is the economics of that industry, but then the ability to essentially gamble on the
Yeah.
outcome of the criminal case, I just find extremely like morbid and disturbing,
Oh, yeah.
and hopefully is not a sign of things to come in 2025. But I will
I
leave that
hope
there.
not. No, I mean that's a good warning. As it relates to everything around gambling, I don't have good feelings about 2025, and your example in particular is very Black Mirror episode ish in a way that
Yeah,
I find pretty alarming. Mine is also connected to recent events. Jason, you've like detoxed from Twitter, so I don't know that you'll even know what's happening with the story. But to catch you up, there's this sort of fun debate, and I put fun in massive air quotes because it's not fun at all, that sprung up around sort of immigration, and in particular, sort of highly skilled immigrants. And should we be allowing highly skilled immigrants? Should we restrict immigration from that corridor? What does that mean? And Vivek Ramaswamy, who is, along with Elon Musk, one of the leaders of the Department of Government Efficiency, not a real government department, but a initiative to try to get government to run more efficiently under the Trump administration. He weighed in on this debate about sort of the need for more highly skilled workers, by which apparently we mean software engineers specifically, and sort of I guess, opined on the reason we don't have more highly skilled engineers in the US as mostly being the fault of 90s American culture, which I found fascinating because I was a kid in the 90s and I experienced this culture myself. And I did not turn into a great software engineer. I'm not a top, 0.001% software engineer. So maybe this proves the point. But it's a pretty great tweet if anyone is listening who's on Twitter and wants to go look at it. He literally actually talks about Corey from Boy Meets World, who he thinks should not be a role model for American culture. I didn't think he ever really was that much of a role model, was my impression of the time. And I think to the extent that he didn't get good grades in the fictional school that he went to, that's entirely the fault of Topanga, who he was distracted by because she was wonderful and everyone should be distracted by her. And then he also talked a little bit about like Friends reruns, and people shouldn't be watching those as much as they should be watching the movie Whiplash, which, if you've seen Whiplash as a movie, you should see exactly one time and then never watch again because it's not exactly the most cheerful movie in the world. Anyway, it's a really unhinged tweet that tries to connect 90s culture things that he doesn't like to the fact that we don't have enough highly skilled engineers in this country. Wild stuff. And I really am continuing to think about it. I can't wait for Doge and the Department of Government Efficiency. This is just going to be magnificent.
I did not catch the tweet itself because I have been on a Twitter detox for the most part. I did see a couple of news stories bubble up, and I resisted the urge to click on them. So thank you for explaining what this what this holiday season kerfuffle was about.
I think what we should do, Jason, for 2025 is you stay off Twitter, just no Twitter, and then we can just make this segment Alex explains or tries to explain what the hell's going on Twitter every month to you. Maybe we do that as the way to both have you lead a healthier life in 2025 and get some entertaining segments for the podcast as well.
I like that idea. We will have to brainstorm this offline.
We will do a little brainstorming. Regardless, we will be here for the duration of all the craziness that is to come. Jason, great to see you. Can't wait to see you in person, and can't wait to continue the podcast with you in 2025.
Can't wait.